Good evening, everyone. I'm Daniel Shrimsky, Managing Director of Vanguard Investments Australia. It's an honour to welcome you all, our foundational members, to the first annual member meeting for Vanguard Super. I'd like to begin by acknowledging the traditional custodians of this land I'm joining you from today, the Wurundjeri Woi-wurrung people. I pay my respect to their elders past and present. I extend that respect to custodians of the land you are all joining us from today. This meeting represents yet another exciting first for Vanguard Super members, and I'm joined here by a passionate group of people that I've had the pleasure of working with through the development, launch, and first year of operations. Joining me in person and online are representatives from our Vanguard Super Board, the Office of the Superannuation Trustee, and leadership team. Tonight we'll explore some of the insights and expertise that underscores Vanguard Super, an update on fund and investment performance, and discuss some plans for the future. We have presentations from Vanguard Super Chairperson Peggy O'Neill AO, Chief of Personal Investor Renee Smith, Global Chief Economist Joe Davis, and Chief Investment Officer for Asia Pacific Duncan Burns. After the presentations, we'll move to a Q&A session, and for those of you who haven't pre-submitted questions, you can add them throughout the live event. For those of you already familiar with the Vanguard Group more broadly, you'll know we're an investment company that does things differently, and this goes right back to our founding 45 years ago. Our founder, John Bogle, known to most people as Jack Bogle, implemented his bold vision for a company with no external shareholders and where all profits are invested into the business to improve outcomes for clients and, importantly, to lower costs. To this day, the Vanguard Group has no external shareholders. That means no share prices to protect and no profits to generate for outside owners. Mr. Bogle was fond of the saying, "Treat your customer like an owner." It's an ideal we live by, and it remains a defining feature of our culture. At Vanguard Super, it manifests in an unwavering focus on our duty to act in the members' best financial interests, ensuring all decisions are guided by delivering the best possible retirement outcomes. While Vanguard Super is still a new entrant in superannuation, it benefits from retirement experience that extends decades, both locally and globally. For over 20 years, Vanguard Investments Australia managed investments for some of the country's biggest superannuation funds, and the Vanguard Group globally has been focused on improving retirement outcomes from the early days in the US. Since launching retirement accounts in the US back in 1981, our focus on research and innovation has led to a range of industry-leading retirement products and services. This includes the launch of target date funds in the US back in 2003. These products are designed to manage risk and grow retirement savings through a lifetime. And as you may have guessed, they share DNA with Vanguard Super's flagship life cycle investment option. This is just one example of how we're leveraging over 45 years of deep investment expertise to deliver and develop Australians a simple yet sophisticated retirement solution. Our Head of Investments, Duncan Burns, will have more to say about this innovative investment option later in the meeting. Understanding our members' retirement needs is critically important as we continue to innovate and evolve. So this year we conducted the inaugural How Australia Retires study. We explored attitudes and behaviours of Australians as they work towards this important time of life and uncovered a range of insights. I want to share one that resonated with me, and it relates to something many of us are looking for: confidence in our financial future. The research showed that the people most confident about retirement are those who have completed some form of planning. That could involve developing a financial plan, budgeting, having a contribution strategy, or seeking advice. And for those that prepared a detailed retirement plan, they are 6 times more confident compared to those without one. Engaging with your super and planning are the most effective ways to not only achieve a successful retirement, but to alleviate the emotional burdens and anxieties that we might feel about this phase of life. Your engagement with us this evening tells me that you are all on the right track. A lot of today's meeting will look at the year that was, but I also wanted to look ahead a little. I'm very excited to share with you that in the coming weeks, we'll take another significant step forward with the launch of Vanguard Super's pension offer. With both a transition to retirement account and an account-based pension, we're thrilled that Vanguard Super will soon be able to support you through the full journey to and through retirement. More to come on pension very soon. Thanks again for joining us. I'm excited about the future and what we can deliver for you all. It's now my pleasure to introduce the Chair of Vanguard Super, Peggy O'Neill AO. Welcome, Peggy.
Thank you, Daniel. Let me begin by saying how delighted I am to be participating in the first Vanguard Super annual members meeting. A warm welcome to all of you online today. Thank you for joining us on this occasion. You will have also received your first annual report and member statement. If you have not yet read the report, I encourage you to do so. It's been a busy year, and today's meeting is an exciting milestone for everyone involved in the successful launch of Vanguard Super. When we officially launched Australia's newest super fund in November last year, it was with a genuine sense of excitement about the opportunity ahead for our future members. At the time, we shared our clear and simple purpose: to reshape superannuation for the benefit of all Australians and enable financial peace of mind. It's a mission grounded in the same solid principles that have underpinned the superannuation system in Australia since the introduction of compulsory super back in 1992. But we didn't launch a new fund just to be like everyone else. We launched Vanguard Super because we felt strongly that there was an opportunity to create a fund that genuinely met the expectations of all Australians and in turn helped meet their financial needs in retirement. From day one, we wanted Australians to compare Vanguard Super to their existing super fund and see that we're different by design. We're different in fees because fees matter. Australians pay over $30 billion a year in fees on super. We're very proud of the transparency we've provided to members on fees because we quote our fees as a yearly fee, incorporating the administration and investment fees and costs, as well as transactions cost. We're also different in investment acumen. As you may already know, our default MySuper option life cycle automatically adjusts the investment mix from age 48 until age 82. This means the life cycle model will do the work for you, incorporating more growth assets in your younger years and adding more defensive investments as you near retirement. It's an intelligent design and a real standout in the market. We're also different in simplicity and ease. We believe saving for retirement shouldn't be complex. Simple fees, a simple product menu, and above all, transparency. Delivering on this bold vision was always going to require an enormous amount of energy and hard work. Our registrable superannuation entity license was issued on 25th of August 2022, and our MySuper authorization followed on the 20th of September 2022. Achieving these milestones was only made possible by huge contributions in time, energy, and resources from the board, the Office of the Super Trustee, and the strong leadership and collective expertise of all operational areas, including our service provider. I'd like to spend a moment introducing each of the trustee directors who are joining us online. Cynthia Louie, Jeremy Duffield, and Ann Flanagan. And Colin Kelton is also a director, but is in the United States and couldn't join us tonight. Members can certainly be confident of the depth of industry knowledge and experience that the board possesses. Vanguard Super's public launch in November 2022 was an exciting milestone. But the launch also coincided with a tricky set of macroeconomic conditions, both locally and globally. Our view is that the strength and stability of the Vanguard Group, with more than 4 decades of global expertise, represents a significant benefit to Vanguard Super members. Later, you'll hear from the Vanguard Super's Global Chief Economist and Head of Vanguard's Investment Strategy Group, Joe Davis. Joe will bring his global perspective to these challenges and provide further insight into how he sees economic and market conditions tracking over the medium term. Given the economic picture, it's no surprise that the past 12 months have presented some challenging conditions for investment returns. But as with any finite investment period, it's also important to keep the big picture in mind. The ups and downs of the past 12 months underscore the importance of a long-term perspective when it comes to investing for retirement. The discipline of being able to look through short-term market events, past the attention-grabbing headlines, and to remember that super is something to be thought of in terms of decades, not years or quarters. Vanguard Super was in the market for about 9 months as at 30 June 2023, and we're pleased to report has started strongly. As you know, Vanguard Super Save Smart, our accumulation product, includes our MySuper Lifecycle Default and also offers a choice of diversified and single sector index investment options. Our yearly fee is one of the lowest annual ongoing fees in the Australian superannuation market for member balances under $50,000. In the reporting year ended 30 June 2023, Vanguard Super had 8,880 members and assets under management of $610 million. We've continued to grow since then. In short, we're very proud of the way we've designed and delivered Vanguard Super Save Smart. But I think I speak for all involved when I say our proudest moment was when we welcomed our first members. It's now just over a year later, and we're incredibly pleased with the way the fund has been received and the way it upholds the promises we've made. We keep a close eye on the quality of our members' experience with the fund and certainly want your interactions with us to be positive. The evidence so far suggests this is overwhelmingly the case, and something on which later speakers will elaborate. One of the topics we're constantly thinking about is the changing retirement landscape. Just 1 or 2 generations ago, retirement was relatively short and expectations were more modest. Generally, we're now enjoying longer and more active retirements than ever before. In fact, as life expectancy increases, retirement savings may need to last for 30 years or more. As a result, superannuation is expected to do more heavy lifting for the retirement lifestyle we all aspire to. This continues as an area of focus for us. How do we build retirement income solutions and tools that give our members confidence that their super will last and meet their needs, while also being mindful that many worry about outliving their super savings? It's not just enough to understand those challenges. Members need retirement solutions that meet these challenges. I'll provide some more detail a bit later about the retirement income products we've developed. As a board, we also look after your interests through more formal advocacy efforts and having a strong voice in the industry. We're working with regulators and regularly discussing industry issues so that we maintain an open and trusting relationship. In the past financial year, our advocacy efforts included making submissions on legislative proposals to improve the efficiency and accountability of the super system, as well as the financial outcomes for members, and also to improve the accessibility and affordability of financial advice for all Australians. As I've already mentioned, retirement and superannuation can be complex. There are many opportunities and challenges facing working-age Australians as they prepare for retirement. Our research shows roughly 1 in 3 Australians believe they won't be financially ready when the time comes. Another key challenge is how members engage with their superannuation fund. Research shows 1 in 2 working-age Australians have not made contact with their fund in the last 12 months, while 3 in 4 retired Australians have not made contact in the last 6 months. The superannuation industry needs to find new ways to boost member engagement. This wasn't lost on us, as when we were designing Vanguard Super, we had the opportunity to rethink those old methods of engaging members and look at how it can be done in a more meaningful way. I hope that those of you who've logged into your dashboard on Member Online can attest that the online function is easy to use. Our plans are to further personalize your super experience over time with new tools and enhancements. And as Daniel mentioned, we're on the cusp of another milestone with the launch of our pension offering in the coming weeks. Complementing the Save Smart accumulation account, we'll introduce Vanguard Super Transition Smart, a transition to retirement account, and our account-based pension, Vanguard Super Spend Smart. These pension accounts can support members as they transition into retirement and then provide a steady income stream when they're ready. So it's been an exciting and successful inaugural year, but there's more to come. Our focus on improving the member experience continues, and we see many opportunities ahead. In concluding, I'd like to thank all our members. Entrusting us to protect and grow your retirement savings is a responsibility the trustee takes seriously. And we look forward to many more years of working hard for all of you so that you have financial peace of mind.
Thank you, Peggy. It's now my pleasure to introduce Renee Smith, Chief of Personal Investor for Vanguard Investments Australia.
Thank you, Daniel, and good evening, everyone. I'm Renee Smith, Chief of Personal Investor at Vanguard Investments Australia. Joining Vanguard in July this year, I look after our direct-to-consumer business, of which Vanguard Super plays a major role. It's a great privilege knowing that this responsibility is directly tied to members like you and your financial well-being in retirement. A comfortable retirement is something every Australian rightly wants for themselves. As some of our first Vanguard Super members, I don't need to tell you how important your choice of super fund is on achieving your retirement goals. We saw the launch of Vanguard Super as an opportunity to do things differently when it comes to investing for retirement, particularly as it relates to fees, investment options, and experience. Tonight, I'll be talking to you about your choice, Vanguard Super, and where we stand on some of these critical factors. We're just 1 year into our life as Australia's newest super fund, and the team are encouraged by the positive response. Most importantly, we're delighted by the way it's performing to uphold the promises we made to you. We know that there's more to the journey than just the destination, and our goal is to become your trusted partner for life when it comes to your super, meaning your journey both to and through retirement. To earn and maintain your trust on that journey, we're committed to understanding and continuously enhancing your experience with us, day to day and in the long term, as we help you work towards your goals. Tonight, I'll talk to you about some of the things we've learnt from our members and how we're using those insights to make good on that commitment to you. Before we launched, we learnt about needs and expectations relating to fees and transparency. You care deeply about fees, and for good reason, because we know that fees have a significant impact on retirement balances and outcomes. Fees matter, and so does transparency of these fees. That's why we present our fees the way we do, quoting them as a simple yearly fee. It's why our administration fees are deducted each month and transparently reported in your transaction history. We also created an online calculator, which you can access on our website, that enables you to clearly see the breakdown of separate costs. Our intent from the start was for our fees to be straightforward and easy, so our members will never be in the dark on such an important part of their super. During the year, we've learned more about how you want to engage with us and the sort of experiences that you value. You've told us how important great digital experiences are and that you value smart apps that are easy to use along with simple tools that help you make decisions about your super. These are the things that make a difference. Currently, 90% of our member interactions are digital. We know many of you are logging in via your mobile, so naturally you want that experience to be as easy and intuitive as possible. In recent months, we've taken on board that feedback and made a number of enhancements, two in particular. Firstly, relating to our Vanguard Super app, we've added facial and fingerprint recognition to make the login process simpler. And we've already seen an uplift in usage as a result. Around 3/4 of all logins to our app are now done using this new functionality. Another area of focus has been insurance. Significant work has been completed to uplift the end-to-end experience to ensure that members who want to apply for or adjust their insurance or to make and track a claim can do so digitally via AIA's digital underwriting and claims solutions. When it comes to building digital experiences suited to your needs, we want to make sure that we identify any points of pain early and apply those insights to solve those areas of greatest need. One of the insights that we've heard is that we can do better when it comes to displaying your super performance. So we're working on making improvements on that now. We've also heard we can improve experiences in the app, and that's also something else that we're focused on now and into 2024. So those are two key areas where we've heard from you and made changes. But there's always more to be done. A year on from launch, and we continue to seek feedback through our Voice of Member program on what we're doing well and where we can improve. And overall feedback from members suggests that we're getting it mostly right when it comes to everyday interactions with us. Overall member satisfaction for those who contact us is almost 95%. When we ask members, how likely would you be to recommend Vanguard Super to a friend or a family member? Members respond positively, with almost half responding 9 or 10 out of 10, and a third of members giving us a perfect score of 10 out of 10. When we dig a bit deeper on all these results, we find that you rate us highly for our proven expertise in investments and global markets. Another strength is our ability to cut through complexity. Almost 2/3 agreed Vanguard Super makes it saving for my retirement easy. And we do this with a simple online experience. Some of the feedback we've heard on this is Vanguard is super easy to configure and set up. Obviously, it's not all positive, and certain pain points remain. For example, you've told us that you want more detail on investment products, and I've spoken about our focus on improving the way in which we present certain information. Importantly, we're listening, and we're keen to address those opportunities as we identify them. I'd like to conclude by saying thank you. Thank you to those of you, our first group of members, who have entrusted us to protect and grow your retirement savings. I'm a big believer that our ability to listen well and truly seek to understand your needs as they evolve will continue to distinguish Vanguard Super and ultimately help us to support the best possible retirement outcome for all members. I invite you to hold us to account on that. Now you'll hear from Joe Davis, Vanguard's Global Chief Economist and Head of Investment Strategy Group, who will provide you with some timely commentary on global and local economic and market conditions.
Hi, I'm Joe Davis. Economies have certainly been resilient despite the 2023 rate hikes, which were clearly aggressive. In the United States, the post-COVID recovery was above trend due to strong household fundamentals, excess savings, and a very tight labor market. In Australia, we haven't seen the same level of savings, but there has been lower inflation, a stable labor market, and strong exports to China. Now, currently, there's been a lot of focus on the near term and the risk of a potential slowdown. So what do we at Vanguard expect in the year 2024? Will it be recession or continued resilience? Now, I think to not avoid the question, I wish to underscore the fact that I think the markets in general, and we as investors, we risk missing the bigger picture at work. And that is, we believe that we have entered an era, what we call return to sound money. Well, interest rates will remain on a more permanent basis higher than they were before the period of COVID. Now, what does this mean for Australia? In Australia, we think they will weather the storm, since the China recovery, led by consumption and infrastructure investment, will benefit the key sectors of Australia, such as mining, tourism, and agricultural export. And our outlook for 2024 is influenced by what we anticipate central bankers will do in 2024 and beyond. Now, in Australia, we expect rates to peak slightly, and they may fall a bit, but rates in both the United States and in Australia will stay higher for longer. This has been a theme from Vanguard for over a year, and I will share with you at least 3 key reasons for our view. The first one is an obvious one, and that is the labor market remains tight, despite aggressive tightening from central banks. The labor market tightness is a key indicator for the direction of rates, and has been closely watched here in the United States. Australia's labour market remains at historically tight levels as well. Wage agreements are also stickier in Australia. Now, this moderated wage growth compared to the US, but means momentum may last longer. Now, a second important reason why economies have remained more resilient than expected, and with that, interest rates remained higher for longer than expected, has been that fiscal stimulus has been offsetting some of the contractionary effects of monetary tightening. The United States is a perfect example, where government spending is pushing higher economic growth. Now, in Australia, fiscal policy has also had a somewhat offsetting effect, as policy rates were tightened initially, though this has been lesser degree than in the United States. And there has been recent focus on fiscal consolidation. And perhaps the third and perhaps most important reason why we believe this return to sound money has permanence is that there will be higher for longer because the fundamental drivers of interest rates have changed since they occurred pre-COVID. Now, in the near term, that means that more work will need to be done to return inflation to central bank targets. And longer term, we believe rates will settle at a structurally higher rate than they would have during the depths and aftermath of the global financial crisis. Indeed, we have research that has looked at the structural drivers of higher long-term interest rates in the United States, including aging populations and structural fiscal deficits. And in Australia, rate hikes have been slightly less aggressive compared to the US, due in part to less severe inflation and labor market pressure. Ultimately, we see central banks easing a bit over the course of 2024 as growth continues to slow. But at the same time, I think we have to keep in perspective that rates will be unlikely to drop dramatically, much as they perhaps would have done over a decade ago. This, of course, has important and profound implications for investors. One of the most important implications is that this has a powerful compounding effect, and one of the reasons why we believe we will have higher expected returns in the future. One of the second reasons is because with higher interest rates, fixed interest investments will have a higher appreciated point of return. And with that, the equity risk premium over short-term interest rates will be compelling for long-term investors. So are there headwinds in front of us in the year ahead? Yes, but nevertheless, I believe the more important and arguably the single most important development in the financial markets over the past 15 years is that rates will have a permanence at a higher level. And with that, we as savers and as investors will benefit from not compounding at close to zero interest rates, but instead compounding at rates of 3% or higher. This will increase our probabilities of success for savings for retirement or other goals that we have in our personal lives. As I said, this return to sound money may lead to more informed capital allocation in public markets and in markets around the world. So ultimately, this is a very powerful change in the global economy, something that many may not have believed would occur just as short as 3 or 4 years ago, but nevertheless is a powerful tailwind for investors as we go in the years ahead. Our asset return outlook suggests risks and opportunities for those near retirement, for they will certainly benefit from higher yields, but should still expect lower equity returns in the next decade than the previous one, just based upon valuations. Our outlooks affect members differently depending on a number of factors, an important one being age. Younger members with multi-decade time horizons have the luxury of looking through economic and market cycles. And I would argue they should focus on controlling what they can, tune out the market noise, and stay the course, which means sticking to the plan. Members closer to retirement, who previously had a high, probably reasonably high probability of success, can be more sensitive to market conditions. And for these investors, there is good news and more cautious news. Now, the good news is that the estimated probability of success is significantly higher than what it would have been just 21 months ago. Again, a very positive benefit of a return to sound money. Now, the more cautious news is that equity valuations across several markets are still elevated. And so the expected returns of stocks over bonds will push down some of those expected returns, at least in the near term. That being said, I think all investors, we should not feel destined to live at the mercy of short-term market ebbs and flows. In fact, we have powerful options in our toolkit which can even help recoup short-term market losses. Again, when we can leverage our proprietary asset return and retirement saving models to actually simulate what are the probabilities and the impacts of market and return outlooks on the outcomes that we care about. And I can tell you the conclusion is pretty powerful. And that is some of the things that we have the most control over in our own goals can have the most powerful impact, almost regardless of what the markets do in the near term. Where you see in the graphic, saving more, sticking to the plan, and if you can save and perhaps even work just a little bit longer, regardless of the market environment, that has positive nonlinear effects that increase the probability of success. And again, along with higher interest rates, that's that compounding fact that we all talk about. So as we look into the year 2024, I want to thank you for having me, and I hope to see you soon.
Hi, I'm Duncan Burns, the Chief Investment Officer for Vanguard Asia Pacific. It's a pleasure to be with you tonight, and I want to give you a sense for how we go about managing your money. I lead and support a money management team of 55 plus local investment experts. Think portfolio managers, traders, risk analysts, and economists who look after your super and over 750 billion Aussie dollars that Vanguard Group has invested across Asia. Now, that's a staggering sum, but we never lose sight of the fact that it's all your money and you, our clients, have entrusted us to look after it. In the next 10 minutes, I'm going to lift the lid on Vanguard's investment philosophy and the approach we take to growing your super. First off, I'll talk about indexing, the core of Vanguard's investment approach. Second, I'll provide some insight into how our flagship lifecycle fund delivers outstanding investment outcomes. And third and finally, I'll reflect on the performance of Vanguard Super since launch. So let's get into it. And first up, the philosophy and value of indexing. While we're the newest super entrant in Australia, it's easy to overlook the fact that Vanguard Group has been doing this for a while. In fact, the Vanguard Group has been focused on improving retirement outcomes for nearly half a century. A core tenet of our investment philosophy is indexing, the success of which is the main reason Vanguard Group is now the second largest asset manager in the world. The Vanguard Group pioneered indexing in the 1970s by launching the first index mutual fund. And since then, it's become a really big deal as members like you have embraced the strategy as the core of their portfolio. Today, index funds represent around 35% of fund assets globally and growing. And Vanguard Investments Australia brought indexing here to Australia in 1998 when we launched the first retail Aus index fund. And indexing now accounts for around 700 billion or 20% of assets under management locally. The Vanguard Group is proud to have democratized investing and improved investment outcomes for investors worldwide, including over 50 plus million clients, most of whom are mom and dad retail investors like yourself. So what is indexing? Simply put, index funds are investments designed to deliver investors the performance of the market. For example, share index funds, they typically invest in a mix of companies that replicate a specific market, like the ASX 300 here locally. The idea is that investors can elegantly diversify their investments in one go, rather than trying to individually buy a whole lot of different companies like CBA or BHP. As our founder, Jack Bogle, wisely said, don't bother looking for a needle in the haystack, just buy the whole haystack. Now, the key to indexing success boils down to one thing, and that's performance. The numbers show time and time again, indexing has delivered for investors. This slide shows the performance of active funds versus their index benchmarks. And the results paint a strong case for using index funds as the core of your portfolio. The punchline here is most active managers underperform their passive index benchmarks most of the time. For example, the Bellwether Vanguard Aussie Shares Fund, used as a core building block in your super portfolio, has outperformed 75% of Aus large cap active managers over recent 5-year periods. And this isn't just an Aussie thing. We see similar results in stock and bond markets all around the world. Index funds, the foundation of your Vanguard Super Fund, can reliably deliver the market return at very low cost. And this is why index funds form the core of most serious money portfolios. And a big contributing factor to indexing's edge is its low cost. All investors and market participants are subject to costs, and costs reduce investment returns. But because indexing is a low turnover strategy, it lets us keep your costs down. So you get to keep more of your hard-earned money in your account where it belongs. And that really enables us to grow and compound your super nest egg over the years. And to highlight how costs can really impact you, there was a 2018 analysis by the Australian Productivity Commission, and it found that an increase in fees of just 0.5%, which doesn't sound like a lot, can cost a typical full-time worker around 12% of their super balance, or $100,000 at retirement. This could be the difference between retiring early or having to work an extra 2 to 4 years. So that's indexing, a core part of the story and investment philosophy here at Vanguard Super. Up next, I want to share a bit more about our flagship Lifecycle Super Fund and what makes it such a world-class retirement tool. As we stood up Vanguard Super, we took the best of Vanguard Group's investment thinking and retirement expertise, drawn from over 20 years of working with retirement-focused investors elsewhere around the world, and we customized it for our Aussie members like you. The Vanguard Group manages over 1.5 trillion Aussie dollars, or over a third of the global funds under management in the life cycle type investment category, better known as target date funds elsewhere around the world. And Vanguard Super's life cycle product shares much of its DNA with target date funds, which are designed to manage risk while helping grow your retirement savings and provide a lasting retirement income, giving you peace of mind. Our life cycle product automatically adjusts your portfolio as you age, up to and right through retirement. We're gradually de-risking your portfolio. That's selling down growth assets like equities and buying income assets like bonds as you grow older without any extra effort or admin on your part. In the industry, we call this long-term portfolio de-risking process a glide path. And when I think about a glide path, I picture your super as a plane coming in for a soft, gentle landing at the exact point you want on the runway. It's important to know that the goal of this glide path activity is not to maximize wealth. If it was, we'd stay 100% invested in growth assets like equities, but that's far too risky for most as you go into retirement. Imagine if you were 100% in equities and needed to retire just as the GFC hit or during the tech bubble. The true goal of a glide path is to maximize your chances of achieving retirement success. So we're gradually selling equities and buying bonds to take some risk off the table, defend capital as you age, with the aim of hitting your long-term retirement spending and lifestyle goals. And here's our life cycle glide path on screen. To orient you to the slide, we have age on the bottom and percent of growth assets like equities on the vertical. Now, if you're a member under age 47, the asset mix is focused on growth of your super, and the blend there is 90% equities and 10% bonds. From age 47 through 82, we'll adjust the asset allocation every year right after your birthday to de-risk slightly, selling equities, buying bonds. And then from age 82, the asset mix is set to its most defensive posture. That's 40% equities and 60% bonds to help ensure your super lasts and is there to support you all the way through your retirement years. The Vanguard Lifecycle Glide Path stands in a class of its own in the Aussie super sector as one of the few products currently in market that is highly personalized. The Lifecycle product is personalized across 36 separate age cohorts, much higher than the industry average of 11 to 12. Now, equity and bonds are always moving around, so you may be wondering how we keep your super aligned to your glide path. Well, we call that rebalancing. And behind the scenes, a team of investment experts are monitoring your portfolio. And when equity or bond markets move materially, we'll systematically sell high and buy low for you monthly to keep you right on the glide path. So that's the flagship lifecycle product. And while investing can seem perplexing and complex, rest assured we're doing everything we can to make it as simple as possible for you and deliver you the best chance for investment success. Now, let's get to the part you've all been waiting for. Let's talk about the performance of your super funds. We're pleased to report performance of our flagship lifecycle product has been strong from inception. That's October 5th, 2022 through June 30th, 2023. And to read this slide, know that across the bottom, we have the 36 age cohorts from the lifecycle glide path. And the vertical maroon bars represent the returns of each age cohort. In the period, note double-digit returns for the growth-oriented 47 and under cohort over on the left, and mid-single-digit returns for the later part of the life cycle cohorts, where investment options are positioned more defensively on the right. And while Vanguard Super hasn't been in market for a full financial year, making some peer comparisons difficult, our analysis of peer performance for the 6-month period ending June 30 indicates a great start for our members. And we have confidence that these life cycle investment strategies are well placed to continue delivering you world-class long-term investment outcomes through multiple market cycles. So our initial period of market can be counted as a success on a number of criteria. Namely, all our life cycle options are on track. Industry surveys also demonstrate the investment case has stacked up favorably against peers. And advantageous market conditions for equities over much of the financial year since launch means the majority of our investment options have delivered returns in excess of their CPI plus objectives. So that's what you need to know about how your super fund is performing. We're going to be jumping to questions in a moment, but just a few closing thoughts before we do. Hopefully, I've given you a better understanding for how Vanguard is running your super and some of the investment thinking we put behind it. The power of indexing, the discipline of the life cycle glide path, all resulting in strong long-term performance for your super fund. These are the core ingredients for a successful retirement. And while it's early days, we are thankful to you, our first cohort of members, for trusting us to look after your retirement savings. Thank you, and I look forward to providing similarly positive news and updates at next year's members meeting. And now we're going to take a short break and be back in a couple of minutes for the Q&A.
When you sign up to Vanguard Super, 45 years of global investment expertise becomes yours.
Hi everyone, my name is Sue Wallace and I'm the head of the Office of the Superannuation Trustee, and I'll be facilitating today's Q&A with our panel. Please enter your questions in the chat box on your screen and we will try to answer as many as we can today in the time we have, including questions you have pre-submitted upon registration. And any questions we do not get to and their answers will be published on our website in the coming weeks, alongside the minutes from this meeting. And for any questions you have of a personal nature, one of our team will contact you directly. So let's get straight to it. I'd like to start with some questions about our upcoming pension offer that we've touched on tonight. Daniel, I might throw this first question to you. Can you explain the progress that's being made with Vanguard Super's pension offer? What does it consist of? And is there a launch date you can tell us about?
Yeah, absolutely. Thanks, Sue. Maybe the first thing I'd say is, as mentioned, we're thrilled that we are a few weeks away from launching our pension offer, which is very exciting. Obviously, it's a really core part of a Vanguard Super offer. It'll include a transition to retirement account, which will be called Vanguard Super Transition Smart. It'll include an account-based pension, Vanguard Super Spend Smart. And as I said, we couldn't be more excited about those. Both you'll be able to draw an income from, obviously, as a member of Vanguard Super. They'll both operate slightly differently depending on whether you're transitioning to retirement over the next few years, depending on whether you're about to move into retirement or maybe you're already in retirement. So important to note that they will operate differently. I think one of the things we've noticed since being in the superannuation market is that retirement phase of one's life, and I think it came through a little bit in the presentations this evening. It is a complex period in one's life. It is stressful for many. People tend to lean out a little bit, and what we believe is that we need to enable members to lean in, and how do we put simple but effective solutions out there for people that are approaching retirement, and how do we make sure those solutions meet their needs. So that's certainly what we've tried to do as it relates to launching this pension offer. But as I said, thrilled that we are a few weeks away. It's an absolute core part of our offering, and together with that, we look forward to bringing many more valuable services to members in terms of insights and perspectives that we've learned from decades working with retirees in the US.
Great. Thanks, Daniel. Following on from that, Peggy, can you please elaborate on the plans for members to benefit from our innovative super products?
Well, I'd like to think that everything we do is to the benefit of members, but I'll highlight a few things. I think as previously mentioned, our Lifecycle Fund, SuperSmart, is unique in the industry in automatically adjusting the investment asset allocation for members from age 48 to 82. So that takes a bit of the worry out of members having to do that on their own. It de-risks that for them. If they want to, of course, they can change it, but if not, we'll take care of that for them. I also think that members benefit greatly from our low-cost, transparent fee structure. As was illustrated, fees matter, and over one's lifetime, it really eats into what your retirement savings outcomes would be. I think also, as Duncan highlighted, is Vanguard Super gets to take advantage of the great expertise of Vanguard globally in investments. And that makes us quite unique, and I think it's something that no other fund can boast, the kind of investment expertise that we have access to. I think also that while we've launched our accumulation product and we're underway, and as Daniel just indicated, there's a lot more products and services and enhancements that we have in mind. So we've really just gotten started. We aren't finished yet. We've got a long way to go.
Lovely, thank you. And just with your industry experience, can you share your thoughts on how you think the super industry will evolve in the next few years, and what should funds focus on when it comes to serving their members?
Well, I think when you look at the industry, I think the real highlight there we would all recognize has been consolidation of funds, and that we see I think we'll see more of that. I don't think it's done yet, and I think that funds that survive will be even larger, and I think more will be demanded of them, and I think that's rightly so. I think regulators, because of that, will scrutinize funds more carefully, because when so much of the assets of so many people in the country rest in the hands of a few, the regulators would want to be sure that the people who are handling that money know what they're doing, that also that the assets are safe and secure, and that members are indeed at the center of everything that happens. I think also, as we know, the government's interest in legislating the purpose of super, I think that indicates a great interest in being sure that superannuation is being used for the purposes for which it's intended. And I think, again, that's something that trustees will have to adjust. Some trustees will have to adjust their activities to manage that. But I think from members, they will demand sort of more education, more services, I think, and personalization of those services. I think that Renee's alluded to, that's one of the things that's top of our list in our developments. So I think that the funds will need to provide more education. I think that everyone will expect their funds to do that as a matter of course as a service. It's not an add-on, it's what will happen all the time. And I think going hand in hand with education would be advice. I think funds will be required to have some way of getting advice to members, especially as their account balances grow, and especially as in more emphasis now on retirement, the drawdown phase, and not just accumulation. I think up until now we've been focusing on the accumulation more than the drawdown. And as Daniel alluded to, and I'll say again, our research on how Australia saves shows that people who've put the education and the advice into a plan are 6 times more likely to think they will have a successful retirement. And I think everyone wants to have that security and that knowledge about what's going to happen. So back to the original question, I think the industry is going to continue to evolve, and I think it'll evolve quite quickly.
Yeah, Thanks, Peggy. And that's really important to raise advice. And Daniel, I might go to you now. We've had another question about, are there any plans for Vanguard Super to offer advice in the future? So would you like to cover that?
Yeah, absolutely. I mean, I can absolutely say there are no plans for Vanguard Australia or Vanguard Super to get into advice. We have as they say, a full dance card right now in terms of trying to make sure that we're continuing to build out the super offer. We've got a way to go. We think there's tremendous value that we can continue to add. Obviously, pension coming in the next few weeks, but there's so much more that we want to do in terms of giving members great experiences, great insights, building out the offer. So there are no plans to move into advice. One thing I would say for those that aren't completely familiar with the other part of Vanguard Australia, we work with about 12,000 financial advisors across the Australian advisor landscape. So that's about 70% of advisors. We launched the business about 2 decades ago and provide investment solutions for them to obviously work with their clients on. Really proud of what we've built in that business. And one thing that we've learned, and both locally and globally, is the value of financial advice. So we are huge advocates for the industry, and whether it be through research we've done or through interactions we've had with our financial advisors, with the financial advisors we work with, we think there's tremendous value in financial advice in terms of the benefits that it provides members and investors, in terms of enabling them to have a better retirement and for them to live the retirement that they've worked hard for and that they've earned. So we certainly advocate hard. One thing we certainly want to do more on, and I think it's certainly come through a little bit today, is more on guidance and more on perspectives and insights. And like I mentioned earlier, I think it's something that we can add tremendous value on because of the experience that we've had, the 45 years. We've obviously worked with retirees extensively in the US, and there's a lot that we can gain from that. And as I said, just hopefully nudge investors to make really wise investment decisions. And I guess that's a form of advice, but that's more what we would call personalised guidance, where we think we can play a small role in helping direct members to make good investment decisions, and ultimately will help them in the long term.
Thanks, Daniel. Now, we heard the 30 June numbers, but could you provide an update on how many members Vanguard Super has currently and whether the fund is achieving the assets under management targets you have?
Yeah, absolutely. I'd love to. It's something I look at on a daily basis. We are very close to 11,000 members, almost $1 billion in member money under management. So we are very close to the expectations that we set for ourselves in year one. So feel great about that, thrilled with that. Again, I think it's really important to remember it's not the first year that we closely look at. We're trying to build something that over 5, 10, 20, 50 years is going to be a great business, and we're confident in our ability to do that. So yeah, it's nice to be on the numbers that we forecasted 12, 18 months ago, but we've got a long, long way to go, and success for us will be defined by a much, much longer time period. And again, we never lose sight of the trust that members place in us when they invest their money with Vanguard Super. That's something that we work hard on, making sure we maintain on a daily basis, and we've got all our employees focused on that. So, we appreciate that trust and we work hard every day to maintain it.
Thank you. Now, let's take some questions on member experience. Renee, I might throw this one to you. What are the plans for updating our mobile app?
So we know, Sue, that our members, it's important to them to be able to manage and track their super online and through the app. And we're consistently seeking feedback from members on what's the features and functionality that they most need and most value. And the number one priority for members has clearly been to really streamline the login process. And so that's been the rollout of fingerprint and facial recognition to really simplify and streamline that login process. The second priority, which we're currently focused on, is to display individual super performance. So that's something the team are working on, and we look forward to launching next year.
Great. And are there any features in the pipeline to help project my likely balance when I approach retirement?
So that's another experience that we're working on, an important one for our members, and that's leveraging their individual data, their age, their contributions profile, their investment mix, to provide a projection on their likely balance at retirement, along with what could be potentially maximum drawdowns each year throughout retirement to avoid running out of superannuation during retirement. And then also importantly, how taking steps today, what impact that could have on improving that outcome in retirement. So that is another experience that the team are working on and we'll be looking to launch next year.
Thanks, Renee. That's a lot to look forward to. Just while we're on the theme of retirement, Peggy, I might throw a question to you about updating how Vanguard Super is addressing the retirement income covenant.
Yes, the retirement income covenant is relatively new, but in essence, it requires trustees to not only think about how members accumulate their savings, but also to assist them in how their super will be paid out. And the covenant looks for a stable, sustainable, yet flexible way over the period of retirement, whatever that might be. And it was just yesterday, I think, that the government released a consultation paper on retirement phase of superannuation, and we're delighted that that's happened. We think it's so important. But it also shows the emphasis on trustees helping members not only through their working life, but post-working life. And I think that's something that that we could all do a bit better, and I think that's the last report that came from the regulator was, you've had this for a while and we'd like to see some more progress on this. So I think when we think about the retirement income covenant at Vanguard, besides our life cycle product and having some low fees, and especially with the upcoming launch of our pension products, we think that we've made a good start, but there's more for us to do. And I think also you heard just now from Renee about the planning tool that we're working on, about coming up with helping members determine what's a drawdown that they might want to live the kind of retirement lifestyle they want, and also whether during their working life they need to contribute more in order to achieve what they want. So I guess I would just say the covenant is front of mind for, I think, everybody at Vanguard Super right now, and I think we've made a really good start, but we have a lot more ideas to put into implementation.
Lovely. Thank you, Peggy. Now, sort of turning it around a bit now and talking about insurance during your accumulation phase. Renee, I've got a question for you about our default insurance. Is Vanguard working to improve our default insurance coverage? It appears some other funds have higher default insurance cover.
Yeah, it's a good question, Sue. And Vanguard Super default insurance is really a basic level of cover, and that is by design. It includes death and TPD, total permanent disability, sort of basic coverage. And that's by design to try and keep insurance as affordable as possible and to avoid unnecessarily eroding retirement savings. But we do recognise that, of course, each individual member's circumstances are unique, and so therefore are their insurance needs. And so what we have provided through AIA, our partner in insurance, is the ability for members to apply for increased insurance, so increased sums insured for death and TPD, as well as extending their insurance into income protection, should that be relevant to them. And that can be done through AIA, through our digital Life app application, which can be found on our website. So at this stage, no intentions to increase the cover. It's quite deliberately keeping it at a basic level, affordable, and giving members the option to extend if that suits their needs.
Thanks, Renee. Duncan, I might move to you with a question now. We've received a question about the growth of indexing. A member has asked, is Vanguard worried about what happens when index funds get so large as a percentage of stocks owned that they begin to distort efficient price discovery in the market?
I was hoping we'd get to this one, Sue. The quick answer is no, we're not worried about it. And just a level set here, indexing is at about 20% of investable assets in Australia today. That comes to about 700 billion Aussie dollars. And the case for indexing, like the reason we're at that level and we've been growing nicely over the years, it's all about performance. And my friends over at Standard & Poor's run a survey every year called SPIVA. That stands for S&P Index versus Active. And what they do with this report is they measure all the performance of the active managers against their closest passive or index benchmark. And the results of this survey are striking. In Australia, again, you look at large cap active managers versus the ASX 200 or ASX 300. And over the last 5, 10, and 15-year period, 80% of them have failed to outperform the passive benchmark. So, yeah, when you think about what that means for index investing, it tells you that index investing should be a consequential piece of really every investor, almost every investor's portfolio. So that's the baseline. We're at 20% today. Let's talk about growth and why we're not worried about the future. I think about the two investing styles, active and passive. Passive or indexer, we're buying and holding names because they're in the benchmark. And active managers are buying and selling based on valuations in the market. They want to buy things that are undervalued, sell things or short things that are overvalued. And as they do that, they align prices to fair value. And that's a valuable service active managers provide to the markets. Interestingly, the turnover on passive is very low. We're buying and holding. So annual turnover for index is about 10 to 20% a year. If we look at active, they are active. And turnover there is some 50 to 100% a year. So the ratio is about 1 to 5, index to active. And the important thing, getting to the punchline and why we're not worried, AUM doesn't drive price discovery. It's all about trading. And if we were to move to a hypothetical world where indexing was half the market, so 50% of AUM was index and 50% was active, in that scenario, the ratio of trading would still be 1 to 5. So over 80% of the trading would still be active. There'd be plenty of price discovery. And as I look to the future, Europe is some 30% index, the US is 40%. That's where we're headed, and we have a whole lot more room to grow before price discovery becomes a concern in the market.
Fantastic. Thanks, Duncan. Daniel, perhaps a question here for you about Bitcoin. How do you think Bitcoin will define the super industry, and what's the possibility of integration from a regulatory perspective?
Yeah, great question. I would firstly say certainly a lot of attention on cryptocurrency more broadly, but obviously Bitcoin being a big part of it. So certainly been a lot of attention as we look back over the past few years. I would also say that if you look at the last few months, or actually even beyond the last few months, maybe the last year or two, I think it's become apparent that the enduring investment merit of cryptocurrency might not be there, certainly when compared to traditional asset classes. So I think that's probably fair, and most would agree with that. I think the interest is probably as it relates to the underlying technology that supports Bitcoin or various cryptocurrencies, the blockchain technology. I think that's very interesting. And when we think about it from a superannuation standpoint, the distributed ledger technology, I think is very interesting. And the third-party administrator that we work with, Grow, uses that technology. So we're excited by what that will enable us to do moving forward in terms of leveraging data and making sure that we can, again, use that to support members in the best way possible. So I think it's probably the technology that excites us rather than the actual offer of cryptocurrency itself.
Wonderful. Thanks, Daniel. Let's turn to some questions about fees, which is a really important consideration when it comes to superannuation. Daniel, you've previously mentioned that you would be looking to lower costs as the fund grows. And is this still the plan? And what growth milestones would you be aiming to hit before fee reductions start occurring?
Yeah. I think certainly consistent with how Vanguard has operated in this market and globally, we will absolutely lower fees as we scale Vanguard Super. We've done that locally over the past 27 years through other parts of Vanguard Australia, and we've done that globally across 45 years. As we have scaled, we have delivered benefits back to investors. And that will be in the form of lower fees, absolutely, but it will also be in the form of reinvesting back into the business. And that could be to improve the experience that the investor or member has when they interact with Vanguard, or it could be improving investment management practices in Duncan's shop. So certainly, as we scale, we will deliver benefit back to members. I think it's, again, important to remember that Vanguard is different by design, and I think that was talked about this evening. We do not, as a Vanguard group, we do not have any external shareholders, and I think it's important for members to remember that. We have no external shareholders. Our entire focus is on the client and the member, the investor. So that's where our focus is. When we come in every day, we are solely focused on making sure we're delivering great outcomes to members and investors. So again, I don't know what the timeline looks like. I'd hate to put a specific date on it, but again, as we scale, we will absolutely deliver better fees to members. But I will say, I think it's important to point this out, on day one, we were amongst the most competitive in the industry as it relates to our fees across the board. So, I feel great about that. I'm proud to say that, and that's a great day one position, but it's only our day one position, and we will continue to deliver benefits back to members, as I said.
Great, thanks, Daniel. Keeping you under the spotlight, we've got a question online about fees for you, Daniel. Why are super fees higher than the equivalent management fees for ETFs and managed funds? Yeah. I mean, I think it is a great question. I think certainly fair to say the investment exposures are comparable. So I understand where that question's coming from. I think it's very hard to decouple, when you look at superannuation, to decouple the investment fees from the other relevant factors that come into play when you're running a superannuation fund, or the other expenses that you have to incur when running a superannuation fund. And some of the things I'd raise are flows. Obviously, we're proud of the fact that we're almost at $1 billion, but it is only $1 billion. So we've got to really factor in where we are at with the fund when it comes to, in terms of flows, when it comes to pricing our fees. We've also got to look at the competitive landscape. That's obviously an important part, a factor that we look at closely. We've also got to consider other operating costs with running a fund, and they are different across our different products. So if you look at ETFs and managed funds, yes, they are cheaper, but they're run off a different platform and it's a different part of our business. And I think it's really important to remember that. But what we have maintained focus on to this point is obviously delivering great, very transparent fees, making sure that members understand our fees and they can compare them, hopefully in market, even though that is a little tricky given the way some fees are constructed and communicated in the market. But we've really focused on transparency, simplicity, and making sure that, again, we can scale the funds so that we will lower them, and we commit to doing that, like I mentioned earlier. But it's very hard to compare a managed fund ETF with a Vanguard super offer. Great, thanks. Another one for you, Daniel, that's come in online. How do you see Vanguard Super surviving or evolving with other established competitors? What's your plan to make Vanguard Super bigger?
Yeah, I think it's again, I would say it comes back to a lot of what we've talked about today. It's about investment expertise. It's about leveraging 45 years of expertise that you can't get from becoming a superannuation fund in 5 minutes. We obviously draw on a lot of what we gain from working with our US counterparts. We're the only superannuation fund in the market that has an investment management heritage. I think it's really important to remember that. The other thing I'd say is that we really are proud of the fact that an investor or member can come to us and they can invest with us through their superannuation, but they can also invest with us outside of superannuation, and they have a whole of wealth experience. And we think, again, that's very appealing for Australians, where they can, as non-superannuation assets become more and more important, particularly with some of the tax legislation changes or tax concession changes. We think that's going to be an important proposition that'll be appealing to Australians. And then I think we've gained a lot of trust, and I think we have earned credibility over the past 27 years of being in Australia, maybe not in the superannuation space, but I did mention earlier, we used to manage a lot of superannuation money for large institutions who are superannuation funds. So again, we don't take that trust for granted, as I mentioned, but I do think it stands for something, and I think over time we're going to continue to build out the offer, we're going to continue to improve the experience, we're going to continue to leverage the expertise that we have 45 years in existence in the investment management space. And again, I think that'll hold us in good stead. But it's not about the first year for us. We're here for the very, very long haul, and we're excited by that. And we'll keep chipping away at it, and we'll get better as time goes on. But we're proud of what we've achieved so far.
Fantastic. Thanks, Daniel. I might go to you now, Duncan. Looking at uncertainty in the markets, what's the take on residential and personal real estate in Australia? Are there any assets we can invest in with Vanguard that might give us exposure to real estate?
So when I think about uncertainty in the markets, my mind immediately goes to diversification and building a long-term, robust portfolio. And real estate can and should certainly be a part of that. And when I think about diversification, it's not just owning a lot of things, it's owning a lot of things that react differently to the same market phenomena. And that's really key. If I think about how super funds typically get exposure to the property market, there's two standard channels. The first would be through REITs, which are real estate investment trusts. Those are listed real estate companies. And the second is through unlisted exposure, perhaps buying an office building. And lifting the lid on Vanguard's lineup in Vanguard Super, there's actually real estate already in there. So to the investor that asked this question, if we drill down and look under the lid, our ASX 300 benchmark has about 6% exposure to real estate. And our international shares benchmark, which is MSCI World ex Australia, has 2 to 3% exposure to real estate and property. So, I assume that's going to provide a little bit of confidence that super's already baked in there. And just thinking about why we don't overweight super and add additional property on top of that allocation already, it comes down to diversification. And if I think about dealing with uncertainty in the markets, if we're investing more in property, we need to be investing less elsewhere. And the standard there would be invest a little less in bonds and go a little more into real estate. And when I think about the correlation between those assets and equities, they're very different. I've glanced at correlation between property and equities, and that's positive 0.6 going back multiple decades to the 90s. And that means property and equities move together in sync to a degree. If I look at bonds, very different. We have negatively correlated relationship between stocks and bonds in most environments. And that's a negative 0.1 is the number I last saw. So again, if we think we're going to pull out some bonds, add some property in there to diversify further and help with uncertainty, we could actually destabilize the portfolio and do some damage on the diversification side. So hopefully there I painted a picture. Properties in the fund, and as you think about growing property exposure, do it very thoughtfully.
Thanks, Duncan. And another question around asset allocation. Could you explain why Vanguard Super doesn't hold as much cash relative to other super funds?
Yes. So on the desk, we have a term, our portfolio managers and traders call it cash drag. And when we think about investing for retirement, we're looking out 10, 20, or 30 years. And we want to be growing that nest egg as aggressively as we can with equities and bonds to suit a client's risk profile. And if we've got cash parked to the side, that's going to be a headwind in terms of our ability to drive those long-term returns. So, some investors may be thinking, hey, cash, that's the ultimate defensive asset. Why aren't I using equities and cash as the two pillars of my portfolio? We're using equities and bonds because bonds provide better ballast to equities. And again, in an inflationary environment, as we've had recently, they don't look all that great, but we need to look long term. We can't just look at the last year or two and what's happened to the bond market there. And bonds play a valuable role in a multi-asset portfolio as a diversifier. And again, our models show that it's superior to cash in that respect.
Great. Thanks, Duncan. Renee, a question for you about a member and their situation. They've asked how they can keep up with their superannuation after working for only a short period and after a marital breakdown. Could you offer some perspective on this?
Sure. That's clearly a very important and quite personal question for this particular member, and it actually just highlights for me how important it is that Vanguard Super is there for our members. There for our members through the key moments that matter in life, both the ups and the downs. I think quite practically speaking, firstly on fees, it's important to note that our fees are percentage-based fees. So on smaller super balances, the fees are proportionate to the size of the super balance. Secondly, I would mention the opportunity to make additional contributions and how additional contributions now can potentially make a significant difference to retirement balances. And I'd also flag that for lower to middle income Australians, there's actually a co-contribution scheme that the government offers. So that's something worth exploring, and there's information available on the ATO website about that. And then lastly, what I'd say is this is clearly, a tricky situation to navigate for this particular member, and I'd encourage them to consider whether it would be appropriate to consider financial advice in this case. An independent financial advisor could sit down with the member, really understand their individual circumstances, assess their needs, and then make tailored recommended advice for them to really improve and maximise their outcomes in retirement.
Great, thanks. Now we might turn to investments and performance. Duncan, you did touch on this earlier in your speech, but can you again provide an overview of the overall performance?
Absolutely, and perhaps we could bring that slide back up again. So on screen here, we have the performance of our life cycle fund, and this is our flagship super offering. We have the majority of clients and assets here, and the time frame involved is going back to inception, so October 5th, 2022 to June 30, 2023. And over on the left, we have age cohort 47 and under. And again, if you look at the maroon bars there on page, that the vertical represents the return in the period. So just over 10% return there for the 47 and under cohort. And as I mentioned with this particular glide path in this product, as we age every year, we'll be selling some equities and buying some bonds. We have the more defensive portfolios over on the right-hand side of the slide there, and mid-single digit returns there across the rest of the glide path. And when I reflect on the returns in the period, some fantastic numbers there. And the real driver behind that is equities. Strong equity returns in the period are the key. And I don't have a slide for this, but I did also want to touch on our diversified funds. And for that same period, October 5th through June 30, we have a high growth offering for investors that's 90% equities, 10% bonds. Return there was 10.22% in the period. Our growth fund is 70% equities, 30% bonds. That was 8.18%. And balance fund, that's 50-50, 6.2% return in the period. And our conservative fund, which is 30% equities, 70% bonds, 4.37% in the period. So again, a great start out of the gate here. We're thrilled with these numbers and what they mean for the clients.
Thanks, Duncan. We also have a question online for you. How did our fund compare to other large-scale funds for the under 47 age bracket?
There is a super rating service where we can benchmark ourselves against the median, and I don't have those numbers in hand. So this is a question we're going to need to take back to the shop. We'll answer that and get back as soon as we can.
Okay. Now, I think we heard from Joe Davis about the global economic environment, but what does Vanguard Super, bring it back to our members, what does Vanguard Super see as the primary investment strategy challenges in the year ahead?
So the strategy team sitting behind investments is part of Joe's team. So we're very much in line with his thinking. And as we look out to the year ahead, there's probably two themes we're watching, or challenges, if you will. The first is suppressed equity returns. And as we just saw on screen, there's been a great run in equities. So if we think about what that means for future returns and current valuations, we think there's going to be some subdued equity returns in the short term. And the other item we have our eye on is higher volatility of returns. And Joe touched on what's happened with inflation and interest rates. And we think that's going to continue to play out in markets here, particularly on the fixed income side. Now that said, when we look at our super lineup and our super product, we're thinking about the long term. And we've set up these portfolios to ride through multiple market cycles. And we're not looking at the short term here, looking to make pivots to try and position the funds to take advantage of that, perhaps. And what we've seen is, as we've studied that, short-term market moves are not a strategy for building long-term wealth. So as we have a saying inside Vanguard, is stay the course. And as we look out at the challenges in 2024, I think that certainly holds there.
Great advice. Thank you. There's another online question for you, Duncan. Will Vanguard introduce private market investments into their asset allocation mix?
So at this point, we're new to market. We're just launching, and if you think about a private investment allocation, we'd be taking a fair big chunk out of our portfolio and locking it up in an unlisted asset. And liquidity is very important to us at these early stages. So when we look at our equity holdings and our fixed income holdings, they are very liquid. That's, I mentioned cash drag before, that's letting us keep our cash drag way down. So I'll never say never, but for the short term, we are not looking at unlisted. The case for indexing is very compelling, and for the time being, we're sticking with that strategy.
Okay. Well, there's no more questions online, so I think we'll wrap up. Thanks, everyone. We're about to conclude our Q&A. A reminder again that you can find any unanswered questions from this session on our website in the coming weeks. And Peggy, I'll hand over to you to close tonight's meeting.
Thank you, Sue. I want to thank all of my fellow presenters and everyone who helped put our first annual members meeting together. I also want to thank all of you online, those who have joined us this evening and those who more importantly have the trust in us to become the first members of Vanguard Super. So we look forward to working for you for many more years to come. So as Sue said, questions that didn't get answered here, we will answer online. And in the meantime, I hope that all of you have a very good evening. And thank you again.